Hello everyone, my name is Corey Mitchell with TradeThatSwing.com, and in this video we're going to look at the steps to becoming a profitable trader as quickly and efficiently as possible. So we're going to go through some steps, but first a couple of stories. So I started out back in 2005. I was hired right out of university by a proprietary trading firm, and they hired traders who basically knew nothing. And the reason is they wanted people with no preconceived notions. They just wanted you to come in. They didn't even give you a strategy. They basically told you how their software worked and then said, okay, figure out how to make money. And I think this was actually a huge advantage because it forced us, the traders, and there were new ones coming in all the time, and it forced you to basically look at the charts and figure things out for yourself, which is a massively beneficial skill as a trader, to basically be able to sort of self-diagnose, be able to create strategies. So yeah, we're basically thrown to the wolves and said, figure it out. And one of the benefits of this too was that there was new trainees coming in every month. So you basically had to start performing relatively quickly, or someone else that would just take your spot on the floor. So there's this kind of idea that you have to be trading for years to really get it. And that has not been my experience at all. That was not the way it was at the firm at all. It was basically you had to show at least some profitability kind of within a few months. Otherwise, someone else is going to take your spot. Now, that doesn't mean you're making a living off your trading, but you have to at least be showing some progress. And then by month 4, you should be making something. By month 5, your profit should be getting bigger. By month 6, month 7, you should be getting up into kind of making some decent gains. And that makes sense because we were at the firm. This was an actual floor, so we were there all day. This was most of our jobs. I worked a part-time job in the evenings when I started out. Most other people did as well. But we had to be profitable relatively quickly, and at the firm it was kind of around the 6-7 month mark where most people started to be making some pretty good money. And if you weren't, then maybe if you were still showing some promise and you were making a little bit, you were controlling your losses, maybe you stuck around a little while longer. But for the most part, everyone on the floor, and when I first got there, there was, 40 guys on the floor, a couple women. And it was, kind of that mark. And the people who were profitable in that amount of time, and they generally stayed profitable after that. Now, we did have some advantages. Of course, we were given capital, and we had really strict risk management. Someone was watching our risk management. If we got out of line, we had to send emails explaining what we did, why we took a bigger loss than we were supposed to, what we're going to do to correct it. So these were all really beneficial things, which you as even a retail trader, and even now me as just an independent trader, can still sort of implement those things. So that's a little bit of background. It doesn't need to take forever. I do not ascribe to that theory. And the reason is because you can choose how you want to trade. You do not need to learn how a whole bunch of other people trade in order to be successful. You really only need to learn basically one idea. You get good at it, and you can make a living off just that idea. So I guess the next thing is, how do you even come up with ideas? So here's steps to becoming profitable. This is on my website. If you Google just steps to becoming profitable in the search box, this article will come up. I'll also put it below the video on YouTube. And so how do you even start coming up with an idea? And I think this was the power of basically being thrown to the wolves and just kind of looking at charts and then being able to say, like, you can only lose, when I started out, it was like you can only lose like $10 a day. So that was trading stocks. So it was basically you're trading 100 shares, $20 stock or whatever, and you can only lose like $10. That's like 10 cents on 100 shares. So, like, it really forces you to be able to say, like, wow, okay, how am I going to control my risk? I really have to find spots where the price is starting to move. So I would look at charts and just look at points. Like, we know trends move up, they start pulling back, and then they start moving in the trending direction. So that was kind of more my thing. Other people looked at more like rangy stuff, and they were, just trying to kind of capture bid-ask spreads almost, more like a market maker style approach. So everyone kind of found their own niche. I like the bigger movement stuff. And yeah, so I would just look at these charts, and you have the price moving up, it's pulling back, and then starts to move up again. How could I get into those moves and only basically keep my stop loss very small? Because I could only lose like 2 or 3 cents and then try to make 5, 6, 7, 8, 9, 10 cents or whatever it was on that trade. And I didn't even know about risk reward back then. So it was basically just, how do I get into some of these moves? And then, I'd kind of hold it while momentum was going in my direction. And then as soon as it stalled, I would get out. And I'd never read a trading book, maybe like a little bit, but I really had no idea how to trade. And that was very beneficial. Years later, I had been profitable for a number of years. And then I took my chartered market technician, and it really almost messed me up, because now I had all sorts of ideas from other traders who I thought, oh, these people are successful, they must know what they're doing. I'm going about this all wrong. I don't even know what risk reward is. I'm just getting in when I think momentum's starting and getting out when momentum ends. And I've been doing this all wrong. And yet I was making a fantastic living in my early 20s as a trader. So we'll talk a little bit later on about kind of getting some of the ideas from other people out of our heads. But that was basically the thing. I just started looking at charts, and I looked at, with my own eyes, my own brain, where did I think I could make some money? And you definitely, if you see someone online who trades, I know a lot of people buy my courses because they like how I trade. They see some of my charts and they're like, I want to trade like that. So then, you can definitely adapt some other people's methods, but the concept would still apply, where you'd look at the kind of setups they're looking at, and then you'd figure out how you personally want to trade that. And again, we'll talk about other people's ideas in your head a little bit later on. So the people who become profitable very quickly focus on one sort of strategy or one kind of idea, like that idea of, price moves up, it pulls back, and then it starts moving in the trending direction. That is an idea. It's not a strategy yet, but it's an idea. And you can make that idea profitable. You do not need to go out and find something that is profitable, because what you'll find is something that's profitable for someone else but may not be profitable to you because you do not have the same brain as them. So you can make something profitable. You just keep working on it until it becomes profitable for you. So basically, we're going to talk about how to do that. So you could start with any idea you want. You'd start with, well, I like the idea of moving averages. That's simple. So we could look at like a moving average crossover strategy, and then you'd start looking at all the trades that involve a moving average crossover on a certain time frame on a certain asset, and then you'd look at how those trades do, and maybe you realize like, whoa, like just buying every crossover a moving average really sucks. I'm going to lose a lot of money. But then you can start refining that process, and we'll talk about the refining in a bit. But you can just take the idea and realize that you can make that idea profitable if you want to, and if you're willing to put in the work. So you need an idea, and then you pick a time frame. And So I like the idea also of the firm a little bit dictated that we had to be day traders. Well, we had to be day traders. We had to be out by the end of the day. I like the 1 minute chart. Some people didn't even use charts. They were just using the kind of bid-ask spread, like the level 2. So you kind of picked your tools. I prefer charts. I'm more of a visual type person. So I just decided to trade off a 1 minute chart. And I'm like, I'm going to trade the 1 minute chart. I'm going to trade these stocks. I'm going to figure out how to make some money. And so it's a worthwhile endeavor to sit down if you're a retail trader, to like sit down. This might take an entire day to like really think it through, and that's okay. Avoid just clicking buttons and reading more books. Sit down and think about how you really want to trade. Do you want to trade a 1 minute chart? Do you want your trades to be lasting like 2 minutes, like really active? Or do you more prefer, maybe capturing like the bulk of a move for the day? And there's advantages, pros and cons to any method we choose. You can find pros and cons. There's no best way to trade. So sit down and like really think, when can I trade? What capital do I have available to me? So that'll maybe corner us more into one market or another. For example, day trading stocks in the US, you need 25,000. So if you don't have that, you might have to go futures or Forex. And Forex, the spreads are bigger in the US, less competitive than trading Forex outside the US. So and on the website, there's you can type in the search box. There's articles on, kind of the pros and cons of each market, time frames, all that sort of stuff to kind of help you narrow it down. But really think, just how do you want to trade? And what does that look like? What does your personality kind of tell you about how you should be trading? Are you very more impulsive? That's okay. Everyone says you have to be a certain type of personality. That is not true. You can just trade based on what your personality is like. If you're more impulsive, if you like being active, you can't sit still, then maybe you prefer a method like mine was with day trading stocks. I would do hundreds of trades a day, 1 or 2 minutes, not even. Sometimes like just in out, just capturing those little bursts of momentum. And again, I didn't even know about risk reward back then, so I don't have the stats on what my risk reward was. All I know is that at the end of the day I made money by getting in when momentum was there and getting out when it wasn't. And so obviously my risk reward and my win rate were okay back then, but I didn't even know about that stuff when I started. And yeah, so sometimes we can get too fixated on something about what other people are kind of telling us what requires profitability. And yes, those things do contribute to profitability, but you don't necessarily have to know about them to be profitable. So yeah, think about how you want to trade, and then that can be a very personalized you type of trading method. And then we go into this process of, okay, we have this idea of how we want to trade. Then you start looking at some charts, or if you're a longer term trader, you look at fundamentals or whatever you want to look at, and you find a way to basically make that work. And that sounds very backwards to how a lot of books say, where study everything you can, follow someone who's profitable. Yes, that's one way to do it, but you can also just basically create your own trading method. Where did all these trading methods come from? People say there's so many strategies out there, I don't know which to choose. There's some information hidden in there that all these people found their own way to trade, or took ideas from all over the place and then made it their own. That's kind of the hidden message, in that there's so many different ways to trade that you can create another way to trade if you want. When are you going to be placing trades? Time of day. And this doesn't need to be perfect. You're just kind of like hashing out the idea. You're actually, once we start getting into like the refining stage of this idea, that's when you start looking at entries, exits, all that sort of thing. But right now, when you start out, just kind of build one idea of how you would like to trade. then you're going to improve on it. So we're going to talk about, I have a little tweet here which summarizes some things, but we're going to look at how to improve it in various market conditions. So yeah, the average trader, if you're sitting at home, it is probably going to take you a year, because at the firm, we were there all day. We had risk managers, we had other people sitting next to us that could kind of, we could check ourselves against, talk ideas over. If you have access to, some other traders and stuff, your journey may be quicker if you're putting in lots of hours. If, you're just kind of putting in a couple hours a day, or even a couple hours a week kind of learning, your journey is probably going to be a year or more, because it took the people at the firm who were there all day trading, access to capital, those sorts of things, 6 months, 7 months to, start making some decent money. So if you're doing less than that, it's going to take you longer. So that's why I like to dedicate at least 6 months to one idea. Most people who are struggling are bouncing from idea to idea to idea. They're looking for something to tell them how to trade, as opposed to thinking about how they want to trade and then making it happen. You're not going to follow a strategy if it isn't working. I think this is the big thing. Once you get into this mode of, I can create a concept of how I want to trade, and then if it stops working, you just go to work on something else that can work, and you can start to build strategies extremely fast. I could make something work very quickly. If one of my ideas disappears, I can just decide, okay, I'm going to use a moving average, and I'm going to find a strategy that works with that. That's, I think, the difference between people who kind of maybe do okay for a while and then crash, as opposed to kind of career traders. You might have an idea that does really well for a long time, but you can also just, as if things aren't working or they're working really well, you can kind of increase your exposure to things that are working, or decrease your exposure to things that aren't working, and find something that's working better. So this stage is just research. Is about picking an idea. Brainstorming doesn't mean you need to go out and buy a bunch of books or courses or anything. You can just go through charts and you could definitely pick the brains of some traders out there to kind of get a concept of what you might like in terms of your trading. So then we're going to start to define the strategy. We have this idea in our head. So let's go with that idea of we have these up moves, pullbacks, and then the price starts moving in the trending direction again. How do we capitalize on that? So, we don't have the strategy yet. We don't really have the entries, exits, all that sort of stuff. So we're going to look for what we call the trade setup. So this is the basic look. And we don't want to get hyper specific with this, because if you look at a chart each day, so I trade a few different patterns: rounded bottom, TCs, which is basically that really strong move up, pull back, and then a continuation. I have a number of different patterns that I trade that I've developed over the years, but they're never going to be exactly the same from day to day, asset to asset, right? Like one moved up 20%, pulled back 3%, and then ran 25%. The next one moved up 17%, pulled back 2%, went up 14%. It's and then if you're day trading, it might be went up 20 cents, pulled back 3 cents, went up. The next one's moved up 50 cents, pulled back 10 cents. It's never going to be exactly the same. The numbers are going to be a tiny bit different. The percentage movements, how vertical they were, things like that, they're going to be a little bit different every single trade. So we want to avoid this overly analytical state. It's we have to be able to see the basic pattern, and then the process of trading is really about our decision making. And it's okay, is this similar enough to basically what I've been looking at, researching, to warrant trading it? Sometimes we're going to make mistakes, and after the fact we look like, and we're like, whoa, that like wasn't really my pattern at all. And that's okay. That's how we learn. We're going to make some mistakes. Even once we're great traders, we're going to make mistakes because it's all about decision making. We have to be able to identify these patterns when, you know, our mind's in different states each day, the market's in different states. So, you know, some days it's really moving up. There's lots of movement. Other days it's kind of quiet. Other days it's dropping. So, you know, the context is changing all the time, not just for the market, but also who we are, because, you know, some days we're angry, some days we're stressed out, we're thinking about other things. So we need to be able to identify these patterns. Then we start, once we have the pattern identified, we study that pattern, and we're like, okay, where are some basically general rules of where I could enter that's getting me into that move that I'm looking at, or that I've kind of been studying, the move I'm trying to capture, and how do you know when moves are happening? Well, you can just look at historical charts and say, like, the price moved up here. How would I have captured that? The price had a big drop here. How would I have shorted to get into that? And what was occurring just prior to that I could look at and start building a strategy off of. So we're going to look at when we enter and why, where we would potentially exit and why. So we want to think about our exit strategies, because if the price pulls back and then starts moving up and we're thinking that is our entry point, the price is now moving up, at what point are we going to be wrong? Now, when I was at the firm, I didn't even know about stop losses. Basically we were taught, like, if the price doesn't do what you expect it to do, just get out. Yeah, you're going to pay a little commission, but it's a lot cheaper than, you know, the price moving against you. It was only kind of later, once I did get home, my commissions were a little bit higher, and I mean home, I moved out from the trading firm and I was trading on my own, that I became a little more place a stop loss and kind of let the trades play out a little bit more, because when I first moved, commissions were pretty high, whereas at the firm they were a bit lower. So that will also affect how you trade, your commissions, things like that. But yeah, it was more just like, if the price doesn't move how I expect it to, I'm just going to get out. And as long as it's kind of moving with momentum, I'll stay in. So you can consider how you want to exit. Or, you know, once the price starts moving up, you could put a stop loss just below, you know, the last swing low or something like that. So there's different ways we can enter. You could use a market order. You could use like a stop limit. Once the price starts moving up through a certain price, you put out a stop limit order. If you're trading really big positions, you may want to scale into your positions and, you know, buy a little bit when it first starts moving up, then buy a little bit more, then buy a little bit more as it keeps moving up. You're also helping to push the price in your direction. And then it's going to work a little bit in reverse on the way out. We'd either have to scale out as momentum's going with you. So as the price is going up, you sell a little bit. It's going up, sell a little bit. Problem is, if it starts to fall, now you have to sell multiple orders. You know, if you're trading big, as that price starts falling, which is then going to push the price against you. So yeah, all these things. Exit. How are you going to exit losing trades? How are you going to exit winning trades? And we just look through we find these basic patterns, and we find some general rules which would basically accommodate and allow us to get in and get out of these setups that we're seeing. Then we can go through a refining stage. Here's like just an example of a simple strategy I like to use. When you start actually trading this, whether it's like in a demo account or you're just going through historical charts, you're going to start to notice that there's holes in your system. And basically, the more kind of in-depth you go, the more holes you're going to find. So you might find an example where, you know, you've just been looking for this pattern, and all of a sudden, you know, you thought it was going to go up, and then all of a sudden there was just like this massive move down, and you have no idea why. And you realize, maybe you do a little bit of research and you found out, oh, there was like a big news event that came out right then. So this is big for like Forex traders and stuff. It's very affected by news. Individual stocks a little less affected by news, but would still have potentially big moves if like there's an interest rate announcement released during the day. And you might not have known that, but that's why we go through the process of demo trading and trying things out, because hey, now we know that some news events may affect us as a trader, and we need to be aware of those. So then that becomes another little rule we add in. At the start of the day, we check if there's any economic news announcements coming out. So those are the holes. We also may develop some like re-entry rules. What if we see a nice pattern, it's moved up really nicely, it's moving down, and then it starts moving up, and we get in, and then it starts to fall, so we get out. Do we re-enter that trade? If you look at multiple examples of these types of setups, is it worth it to re-enter? What would instigate you to do that, or what would tell you maybe to stay out? And this can all be learned from the charts. You can just go back and look at different examples and say, yeah, on average, it's better for me to get in. This generally produces more money. We know that we're not going to win all of our trades, and you should never hope to win all your trades. So you're really thinking like, if what the price is doing, if it's not doing what I expected, I'm just going to get out. And if it is doing what I expected, I'm going to stay in. And yeah, that's a much better way to trade than just hoping the price will do what you want, always wanting to win. But if you take that approach, you're never going to win, at least not in the long run. So then we have to think about, we've looked at some entries, we've looked at some exit guidelines, we have our setup, we have some general rules, how we're going to get in, why we're going to get in, when we're going to get out, why we're going to get out. And then we have to start looking at risk management. So how much do we take on that trade? If you have $10,000 in your account, do you just throw all of it at that position? As a day trader, generally, I do throw my entire account at positions. Even when I was at the firm, sometimes I would throw, if we had $1 million that we could trade, I would throw, $1 million at a position and try to make, a little bit. I would be scaling into those positions. You can't just throw big money at positions. So as we talked about, that was something, as you get bigger, you'll have to consider scaling into positions or trading stocks with huge volume, generally higher prices, things like that, in order to be able to utilize big amounts of capital. But that's not really the point right now. The point is, how are you going to decide how much capital to use? And how are you going to determine your position size? How are you going to limit your risk? So later on, I developed this idea of, or learned about it, the idea of kind of risking a percentage of your account per trade, so not losing more than a fixed amount. A lot of other people used a fixed dollar amount, so they might have had big accounts, but they didn't want to lose more than like a couple $100 on a trade. So they would just decide, okay, if this is my entry point, this is how many shares I can buy. If it drops to this point just below my entry, I'm going to get out. That will equate to roughly a $200 loss or whatever, and that's what I want to stick around. Of course, markets move quickly. You can get some slippage on your orders, so sometimes they'll be bigger than anticipated, but we want to consider our position sizes, and so that we can control that risk. Because if we just throw our money at a position, a stock can move 5-10% in a day, right? So if you throw a bunch of capital at a trade and you don't really have risk management rules, and you just kind of hold on to that loss, you could be facing down, a huge loss even in a single day on a single trade. So we want to look at not only how much capital are we going to put into trades, but where are we going to get out? And that's why we looked at the exit rules first. And once we have those exit rules, then we can, start to develop this position size idea. We can think about other things. We might want to think about how much are we willing to lose in a day. So we've thought about how much we might want to lose on a trade. Maybe for you it's $10, another person might be $500. Someone might be willing to lose $10,000 on a trade if they have a really big account. But we also want to consider how much would we be willing to lose in a day. What if you have 3 losses in a row? So you were okay losing $200 on a trade, but what if now you've lost 3 in a row and you're down $600? Do you keep trading? That will vary by person. So at the firm, how it worked was basically if your average profitable day roughly was, let's say, $1,000, that's the most you could lose in a day. So that you could, if you hit that, you could basically recoup it by just having one of your normal profitable days. So I like that idea, and that's kind of what I go with. So if you on your decent days you're typically up, $200, and when you start out you're not going to really know this, right? Because you're not going to know how much you can make, but you are going to have somewhat of an idea based on looking through the charts, going through some trades and demo accounts, and just looking at charts. You can add up all the profits and losses you would have had based on your general rules. You can go through and find 100 trades, add up what all the profits and losses would have been, and you're going to have a little bit of an idea. You'll also get a sense of how many losses in a row do you tend to have. If you have a higher win rate strategy, or you're cutting losses, really tiny, and so you don't really have big losses in the sense of the price really moving against you, then you may be able to sustain multiple tiny losses before you get stopped out, or before you have a really big loss for the day. You can withstand lots of those little losses, and then you get your big wins. So you want to look at how your strategy somewhat performs, and that's going to give you also an idea of how to set your loss limits. Because if you look through your charts and you quite often lose you have 5 tiny losses in a row, or at least a string of losses, then you have a big gain, then you have a string of losses, then a big gain. Cutting yourself off at 2 or 3 losses is detrimental to your strategy. You're never going to be there for the big winner. Whereas someone who tends to win a lot and does not have strings of losses in their strategy generally, they may be okay cutting their losses off once they've hit or they're down a certain amount. Let's say 3 losses. You've had 3 losses in a row. That's very uncommon from the kind of looking at the charts and the testing you've done on your idea. Then you may want to cut yourself off at 3. It's just maybe not your day. You also want to consider, was it the market? Was it you? But either way, you need some sort of risk management. If I'm willing to risk up to 1% per day, I'm not going to lose, 1% on a trade, I'm not going to lose more than 3% in a day. You want to establish the rules around earnings. We kind of touched on that. Are you going to hold positions through high impact earnings? I do not recommend that. But I do recommend getting out just before and then looking at re-entering after. Here's something that gets missed most often is once people have entry and exit rules, they just want to exploit that as much as possible. They want every entry signal. They want to just be taking it. But we also have to look at when conditions work and when they don't. And this is how we start making that idea profitable. This is how we can basically take any sort of idea and turn it into a potentially profitable strategy by isolating some entries and exits, but also looking at when the strategy tends to work and when it doesn't. So an example of this would be you come up with that you want to trade based on a moving average. You're just going to use crossovers. When the price crosses over a moving average, you're going to take it when it crosses back below, or you're going to exit, or you can come up with some different exit rules. But basically, let's just say it crosses a moving average, you're going to enter a trade. If you take every signal, results are probably going to be pretty mediocre, because when the price starts moving sideways, that moving average is going to go through it, and it's just going to the price is just going to whipsaw across it, and you're not going to get any big movements once it crosses those moving averages, and you're going to get what we call chopped up. You're probably going to pay a lot in commissions. You're not having any profitable trades, lots of small losses or big losses as the price just whipsaws across this moving average. So you really have to look at, okay, under what conditions is it good for me to buy when it crosses a moving average? So then you're going to have to look at the context around some of those crosses. If the price is already moving sideways, I would probably avoid it. If you've had a big run up and then the price drops below the moving average and then starts moving up and it crosses the moving average, I'd be more inclined personally to take that trade, because you've already had some momentum. Then if it crosses right back below the moving average and is moving more sideways, then I would stay out, because you're looking at the context of when things tend to perform well and when they don't. When and why you won't take the strategies. So you really want to come up not just for rules for when you're going to take trades, your entry rules, but also look at all the crossovers of that moving average in the time frame that you trade, on the asset you trade, during the hours that you trade, and see how is there anything that tells you this crossover is better than another one because of what was happening prior to that signal. You can look at your own trades, or even just looking at historical charts to get a sense of this. And then you go through and refine, and you're sticking to this idea. You're building your rules out. You may be into a demo account now, and you're trying these things out, or you might even be trading a live account with it. I'd start out with small position sizes, even though we talked about position size up here. What you could potentially trade when you're first starting out and you're defining this strategy or refining it, I would keep the position sizes a little smaller, just that as you get better at trading it and as you're refining it, you're not building too deep of a hole if you're experiencing some losses. So you just keep going through refining this, steps 2 through 4. So what are those? Those are your entry rules, your exit rules. We didn't talk about trailing stop losses, but you could incorporate a trailing stop loss if you wanted to, if looking at some of the charts tells you that's a good thing to do. You're going to establish your risk management rules, and you're going to define conditions when it seems to work most often. And again, you don't need to go read a bunch of books to figure this out. You just look at, you've got this idea, you've decided how and where you're going to enter, and then you're just looking at your own charts, your own kind of trades, and seeing, how could I improve on this? What conditions it works, what conditions it doesn't. So you go through this refining stage. The steps above are going to require practice, right? You might be able to see the pattern in hindsight. It takes practice to be able to, in real time, see that pattern playing out, I like to talk through my trades as it's forming and say, like, okay, based on what I've discovered, it'd be decent to enter here. I could put my stop loss here. I'm going to stay in while momentum's there. I'm going to use a trailing stop loss. Whatever you've kind of hashed out in your guidelines. But this whole process, this whole thing could be done in like a day up till, number 6 here. But like number 5, I can come up with a new strategy almost every day. Going through like 100 charts or so, finding a whole bunch of setups, getting a basic idea of where I would enter, where I would exit, what conditions it seems to work, what kind it doesn't. This doesn't need to take a whole long time. You can come up with strategies quite quickly. It's not going to be instant, but yeah, you could do it in a day, kind of sitting for several hours. Then I think the real work here begins, because this is more the stuff that's kind of a lifelong process. You've come up with an idea that's pretty solid, it seems. Maybe you're trading it on demo even profitably, but then people run into problems where they know what they should do, but they don't do it. So we have to work on ourselves, our psychology, and basically being able to notice when we're making a mistake relative to the guidelines. Some people call this performance slippage. I like to call it efficiency. Basically, how efficiently am I following my strategy? If it said to enter here, based on everything we've talked about, the conditions were good, the entry was good, all that sort of thing, and I don't take it, that's a mistake. So whatever kind of the results of that trade, if I made some money, then I missed out on that, and that's performance slippage, or I'm lower in efficiency than I could have been. My results at the end of the month will probably be less than they could have been if I'm missing those types of good trading opportunities, if I've done my work and developed a profitable strategy. You could email yourself every time you make a mistake, just so it's you have a record of it. You can also keep a journal, and you're going to notice tendencies. What are my most common types of mistakes? Some people are way too aggressive. They take way more trades than they're supposed to. They see things that aren't there just because they want to trade, and then of course after you get out of the trade, you're like, oh, what was I thinking? Those are things that we need to work on if we're going to be successful. Other people are way too passive. They just let trading opportunity after trading opportunity go, usually because they're afraid of potentially losing. These are things that we need to work on. So in this article, and if you go up to the top of the website under trading improvement, if you click on that, you'll find just, there's several pages of articles, but you're going to find lots on different topics on improving, mistakes, things that we can do to help reduce mistakes. Some of these are discussed in this article, such as parts negotiations. You may notice little voices in your head like, take that trade. Or once you're in a big profitable position, it may not be time to exit yet, but you have a little voice in your head saying like, get out, we're going to lose that money. We need to work with those parts of ourselves. They're not going to go anywhere. Don't have any false assumptions that trading is going to make you a Buddha. All you have to do is learn how to work with and be able to negotiate with those different parts of yourselves, and it takes work. We can also do identity work. This is something that I like to do, and it's basically what's the type of person I want to be, and I'm going to push toward really developing a dialogue that pushes me toward being that type of person. The final stage is where you let yourself fly, basically, and you have to cut the apron strings. And really, you've gone through this process. You've come up with a trading method that it's how you decided to trade. You've gone through the research. And one of the detrimental effects of studying too much is that now you have a whole bunch of voices inside your head while you're trading. You have this guy who said, hold on to your winners. You have this guy who said, take your profits at, a fixed reward to risk. You have just too many voices in your head telling you what to do. And to be successful, we really need to get our own clear voice in our head. And how do we do that? Well, through this process where you basically get rid of all those other thoughts and you really just commit to, this is how I am going to trade, and you block out other people's voices in your head. Outside of trading, if someone has some advice for you or you seek out some help with your trading, you can filter that through and then decide how you're going to implement it. But you really have to, you've committed to this method, you've said this is how I'm going to trade, And then it has to be that. You have to get rid of those other voices. It's going to be detrimental to you if you've gone through this process and you find ways to do things, but then while you're trading, you said, oh, well, Corey does it this way. I'm going to do it his way on this trade. And this other guy says I should do it this way. I'm going to do what he does on this trade. That's not what you set out to do. You had set out to define how you want to trade. You found a way to do it, and you stick to that. Our knowledge base, it can help us to build our strategies and to gain an edge. But to fully execute that edge, you need your own voice in your head to be dominant. That's what making a strategy your own is. And you'll hear pretty much every trader that's been successful talk about how they made their trading their own. And this means they got rid of other people's voices in their head. They looked at their own data, what they see, what they can see on the charts, how they're going to execute their trades, and they adhere to that. So there has to come a point where you say, okay, I know what I'm doing, and I'm going to go with it. You have become the expert in that specific way you trade. So you might be able to, go get help on psychological things, get some help, but you're the expert on that way of trading. You've gone through the process. No one else has probably gone through that exact method that you're trading. And you're now the expert in it. You can look at successful traders and they're putting out content. They're not absorbing other people's material. I might post my trades. I am not looking at other people's trades. Again, there's like that subtext there. Something that can be learned from that is that successful traders are talking about what they do. They're not talking about what other people are doing. So the more we kind of look at more and more and more traders, the more, again, voices we're going to have in our head. So look at the subtext. What is this person actually doing? Well, they found their own method. They're trading it despite what other people say, and they're being successful with it. So here I talk a little bit about how, when I took the Charter Market Technician program, I actually went through a rougher period because, again, I started to question what I was doing, even though it was working very well. And just too many voices in my head telling me what I should do, and I sort of lost my own voice. And to be a trader, you need to be confident in what you're doing. You need to look at your trades, look at what's working, what isn't working, what conditions it works in. And if you do that process, you're going to know it better than anyone else. No one else can tell you how to trade better than what you've gone through learning through that process of doing this all yourself. So my profits went down. We also want to be aware, you'll hear people talk about, well, Warren Buffett does this, but they're a day trader. Like, that has no relevance to a day trader, what Warren Buffett does. Now, I think Warren Buffett is a brilliant dude, and I love some of his quotes. I have some of his books, but it has zero relevance to me as a day trader, most of what he talks about. So even if you're listening, you're watching this video, I have a website, I put out content, but once you've learned what you need from me, you need to get me out of your head. I want to make traders as self-sufficient as possible so that they're not reliant on me or anyone else. And I think that's the only way you can really trade successfully, is to be self-reliant. Now, that doesn't mean you can't reach out for help every once in a while. If I'm going through a rough patch, I have some trader friends I'm going to chat with, and maybe find some ways, or same with my golf game. When it gets a little off track, I have a golf coach that I'll talk to, and he can help say, well, you used to be doing this, now you're not. But it's really up to me to be able to implement that and get myself back on track. Someone else may be able to point out why I got off track, but it's really up to me. And then, if a method's not really working as well, I might have to trade something else or trade a different way. And then I can go through this approach and develop a new way of trading. So you're never stuck. Because like we talked about earlier, there's lots of people, they develop a great method, it goes away, and they're never able to recover. But so your knowledge is not necessarily a competitive advantage. The competitive advantage, what will make you be able to make a career out of trading, is this whole process of being able to say, how do I want to trade now? And then looking at the market, looking at charts, and being able to say, this is how I want to trade, or whatever data source you use. I like to use charts. This is how I want to trade, and then being able to refine a method. And it does not need to take long. When you're first starting out, like we talked about, it's going to take probably 6 months to a year to really see some good results from one idea. But you can develop that idea very quickly. And as you are trading in a demo account, looking at historical charts, or even as you start live trading, you're going to get more data that you can use to start refining that process. But the more we jump around, the longer that's going to take. The more voices in your head, the longer it's going to take. So at some point, you really have to just say, this is how I trade. I am the master of this method. I've done the homework. The results are all on me. No one else can, trade for you unless you're, giving up your money to them, and then you're not a trader. You're just an investor in somebody else. So if you want to be a trader, you have to go down this path, and this is the most efficient way to do it. So I hope that helps you out and shows you some different perspectives on how to start trading, the most efficient way to do it, how long it's going to take, and then also that, you don't need to read thousands of books, read thousands of courses to be a successful trader. You just need one idea, and you make it profitable.